Alrighty, so we started to cover the sort of basic theory behind liquidity and how we're going to think about it within our trading. And a sort of super and crude quick recap of the previous lesson is that, essentially when you're looking at your price chart and you've got all of, every single price level over here, in a liquid market, at every single price point, literally every single micro pip, there's going to be a ton of supply and demand. There's going to be a ton of volume. There's going to be a lot of market participants ready to trade and transact at every level. So when you have a high amount of liquidity, it takes a ton of volume in order for price to actually move and absorb all of those orders, right? Whereas if there was an illiquid market where there weren't a lot of orders and it was a bit more, a bit more bare, then if a big market participant starts buying in here, he's going to quickly absorb all of that supply, right, until he gets filled all the way up here. Okay, so liquidity is essentially where we are going to be looking for. I'll explain this in a lot more detail as we go on in the other lessons, but it's essentially where. If you're a big player, right, you're going to need a lot of liquidity to enter and exit the market without minimal slippage. You're going to want to be looking for those points in the market where there are a ton of orders. We don't have view of the order book, okay, and also FX is OTC, over the counter, right? There's no central exchange. So how do we do it? How do we read it? We read it through the price action on our charts, okay? So same way with supply and demand, we're not looking at the order book. We are looking at where those orders came into the market that did something significant, right? Broke structure, or ones that, flipped another zone like that, right? Then that's a strong supply zone. And then we can have some general assumption that within this level here, because it managed to overpower supply or because it broke some structure, that these two zones could have a lot of orders within them, right? Where price may tap into it, fill those orders and continue the move. So that's what we've done with supply and demand. Liquidity is another thing where we're going to be trying to identify on our charts, identify where those resting pools of orders may be. Because if you're a big player, right, an institution, BFIs, as people like to call it in the space, banks, financial institutions, let's just continue with that term because it's nice and easy, right? If you're a BFI, generally, you are generally going to be wanting to exit and entering the market where those pools of liquidity are, okay? So essentially, before we get lost in all the source with these next lessons you're about to dive into, because it can be very easy to get lost in this, okay, as we go through this, especially your first sort of time, we can get really lost in detail here. But if you always try and remind yourself every time you're thinking about liquidity, it's just another tool we're using to try and identify where there may have been BFI involvement, okay, where big money may have been getting involved, right? And remember, the whole kind of general philosophy of our trading is to try and spot their footprints and to use that to our advantage to kind of be trading with them rather than against them, okay? That's kind of my philosophy of what I believe I'm trying to do here. So this lesson is supposed to be relatively simple and give you the bare bones of the sort of minimum I'm looking for in the market to identify where we make a general assumption that liquidity will be. So as you can see here, right, bare minimum, we just have a high like that, right? A pivot point in price. So on a candlestick chart, that's what I would need to see, right? So the same way we look at fractal structure, where each candle breaks the previous candle's high, and then as soon as the next candle fails to breach that candle's high, we've had that pivot in price, right? We've had that pullback. That is now a high in the market, and we can assume that some liquidity, there'll be untapped liquidity above that high, right? Because what's happened is you've got orders all here in the market, and as these candles move up, what are they doing? They're filling that order. They filled all of that supply, right? They filled all of that supply, and then they come up to here, and then this order now hasn't been tapped into, right? And then prices start trading back down, and it's filling all of the demand that was left here, right? So this untapped order, or the amount of, to be more accurate, the amount of supply that has not now been used, that is resting liquidity, right? Sitting above that high here, right? So that's why we then use, or if you do it like me, I just use a line with a little X on it just to show resting liquidity there, or we assume there is resting liquidity, okay? And that's the bare minimum, and the same thing for a low, right? So you get that pivot in price, you would have all of this demand here, right? Price is trading through it, it's absorbing all of that demand, it uses all of those orders up, and then at some point, price will pull back. So now you have those untapped orders down here, right? These have not been tapped into, these have all been taken, and now we assume there is resting liquidity below that low, okay? And then everything just stems from that pattern, either a low or a high, and then you can just build it from then on, okay? But it's just basically wherever you see a low or a high, we can assume there is some liquidity. Now, how much liquidity we can assume is resting there, we can get into a bit more in the following lessons, right? And we'll look for things like this, okay? I'll touch on it now, like where if you just have a high like this, okay, maybe it's a weak high, it didn't break any structure, there might be some liquidity behind it. Whereas if you have a high that actually achieves something significant, there could be a lot more liquidity, or we can assume there may be a lot more liquidity behind that high because a much more significant thing has now happened in the market, okay? And what do you think is going to happen for people who are trading this, right? So if someone's already short, where they're going to have their stop loss. They're going to have their stop loss behind that high, okay? Now, if you are short and your stop loss is behind there, what order is your stop loss in the market, right? If you've sold and then price stops you out, what do you have to do to exit your position? You have to buy, right? So when you're short, your stop loss is a buy order, okay? So when you see a high like this, that's broken structure, we can assume there's probably been a lot of market participants who have sold, right? Or what else may happen? When price comes back up, okay, people might want to sell the double top, right? And that's when you'll get patterns like this. So then that can mean there's even more people selling now, right? And there's more stop losses behind here, which means there's more buy orders, right? There's buy side liquidity building up behind highs, okay? Because again, if price comes up and you get stopped out and you've sold, what do you need to do? You need to buy back your position. Now, what's the other thing that can happen when you get this is you can get breakout traders, right? They see that seems like a strong level. If price breaks that, we're probably going to go to the moon. So they want to buy. Or some of you may know bull flag patterns, right? Where you get an impulse correction. And then the next idea is that you get that next impulse. What are people going to do? They're going to buy that, right? So what do you get? More buy side liquidity. So, okay, so whether you've shorted or you're buying, it's a lot of buy side liquidity above those highs, okay? And that's what we assume builds. It's the same with the trend line, okay? Or whatever way you want to do it, kind of a retail pattern. Price comes in for the touch, get short, or 2 touches confirms the trend line. What do you learn on YouTube? Okay, let's sell the 3rd touch and let's get short, right? Or even if you're a supply and demand trader, like we are, right? Break of structure, come into supply. What do? We look to sell, right? And then stop losses can be above the high. And again here, we can look to get short, more stop losses can build, right? So this whole time, what's happening? Buy side liquidity is building up behind those highs, okay? My stop loss is a buy order to buy back my position. And then the exact opposite for the lows, right? Let's just do 1 or 2 examples just to speed this up a bit. But yeah, we have a support floor. If you're long, where's your stop loss going to be? It's going to be below. And your stop loss in this case is going to be a sell order, right? Because if you bought to get long, if price then stops you out, what do you need to do? You need to sell your position back to the market, right? So that's a sell order. Again, if you buy all of these lows, what happens? Tons of sell side liquidity starts to build up below those lows there, okay? So we get what we call sell side liquidity below the lows and buy side liquidity above the highs, okay? Now the importance of this, it will come later in terms of how we actually use it to formulate trade ideas and use it within our trade plan and our strategy and our entry models and all of that fun stuff we will get into. So for now, I kind of just want to get your head around the sort of basics, how we, basically what I want to do now with you is get very clear on what our definitions are, okay? Especially when we look at sweep zones, we'll look at the things individually. And then as we go through, we're going to start to put all of the pieces of the puzzle together again. And that's when we might get lost in the sauce a little bit, right? So let's try and build up slowly and we'll get there. But let's just now go have a look on the charts at some sort of basic liquidity identification.